This is Market Pulse by Capital Chronicles. I am Vanessa, and this is your daily tactical briefing on the forces moving global liquidity. Right now, the global economy is staring down the barrel of an 8 p.m. Eastern deadline. President Trump has issued a direct ultimatum to Iran: reopen the Strait of Hormuz, or face the obliteration of power plants and bridges. The clock is ticking, and the market is holding its breath. But while the mainstream media is obsessing over crude oil, they are completely missing the hidden black swan that could wipe out the entire artificial intelligence sector by the end of the month. I'll show you exactly what that is in just a moment, so do not touch that dial. Let's break down the macroeconomic crucible we are currently trapped in. Operation Epic Fury has effectively closed the Strait of Hormuz for 5 weeks, and 20% of the world's oil and LNG is bottlenecked. Brent Crude posted its largest monthly gain on record in March, surging over 63% to smash through the $100 threshold. Here is the terrifying math for the Federal Reserve. Every $10 increase in crude oil adds roughly 30 basis points to baseline inflation and shaves 15 basis points off GDP. We are dealing with an energy premium far beyond $10. This means the 4 to 8 week lag for the cost of fertilizers and synthetic fibers to hit the CPI is happening right now. Stagflation isn't just a risk anymore, it's reality. Before we dive into the wild decoupling of gold and Bitcoin, make sure you hit that subscribe button right now. Here at Capital Chronicles, we will upload every single time the market moves or a new catalyst hits the tape. You need this intel to survive the volatility, so subscribe and stay ahead of the curve. So how are the safe havens holding up? Well, if you were holding gold, March was an absolute bloodbath. Gold plummeted nearly 12%, suffering its worst monthly decline since the 2008 financial crisis. Over $12.8 billion bled out of commodities ETFs. Why? Because rising energy prices killed the dream of Fed rate cuts, sending the US dollar and Treasury yields into the stratosphere. When risk-free yields spike, non-yielding physical gold gets dumped to cover margin calls. For the technicians, keep your eyes glued to the 4,600 level. If that 100-day moving average breaks, look out below. But while gold capitulated, Bitcoin decoupled. Bitcoin surged 7% during the peak of the March chaos. We saw massive capital flight from Iranian exchanges straight into self-custody wallets, proving Bitcoin's utility as a borderless, censorship-resistant rail. With over $1.6 billion pouring into spot ETFs, Bitcoin has found a serious floor near $68,000. All right, let's talk about the broader equity markets. The S&P 500 just closed below its 200-day moving average for the first time in over 200 days. That is a massive red flag. But there is alpha to be found if you know where to look. The rotation into defense and domestic energy is violently real. Aerospace and defense ETFs are up nearly 8% this year. Stocks like Woodward and Innovative Solutions are posting massive double-digit gains, backed by structural government contracts. Meanwhile, U.S. domestic energy plays like OXY and Enbridge are printing money, totally insulated from the Middle East chaos. Now, let's talk about that black swan I mentioned earlier. Everyone is looking at NVIDIA's record $68.1 billion revenue and the massive data center build-outs. But AI requires physical memory, specifically high-bandwidth memory chips fabricated in South Korea. And those foundries require two things: massive amounts of LNG electricity and helium. Qatar produces 30% of the world's helium, which is absolutely mandatory for cooling and leak detection in advanced chip manufacturing. With the Strait of Hormuz shut down, that helium is trapped. There are no rapid substitutes. If South Korea doesn't get the power and the gas, the chips don't get made. NVIDIA's software dominance means nothing if the physical hardware supply chain collapses. Price that risk into your tech portfolios today. So what happens after the 8 p.m. deadline? As a trader, you need to strip the emotion out and play the probabilities. Here are the 5 scenarios you need to model right now. Scenario 1, kinetic war. Iran ignores the deadline, the U.S. strikes the power plants. Retaliation hits Gulf infrastructure. Oil goes parabolic to $130, maybe $150 a barrel. The S&P breaks 6,300, and global stagflation is locked in. Buy defense, buy domestic energy, buy the VIX. Scenario 2, the miracle ceasefire. Pakistan brokers a last-minute deal. The strait reopens. Oil crashes back to $75. Inflation fears vanish, rate cuts are back on the menu, and the S&P rockets towards 6,600. Scenario 3, delay and prolonged disruption. The deadline is extended, but no deal is signed. We sit in purgatory. Oil stays stuck between $90 and $110. This is a slow bleed for equities as inflation slowly chokes the consumer. Short the euro-dollar on any rally. Scenario 4, third-party intervention or world war. The Red Sea is totally blockaded, or the U.S. walks away and China steps in, forcing energy to be settled in the Chinese yuan. If dollar hegemony breaks, the inflation imported into the U.S. will be biblical. In this scenario, scarce, non-sovereign assets like Bitcoin could experience explosive upside momentum. And Scenario 5, everything magically returns to normal. Highly unlikely today, but if it happens, emerging market hard currency debt will be the trade of the year as global supply chains repair themselves. The volatility we are about to see is historic. You cannot afford to trade this market blind. We will be right here tomorrow, dissecting the fallout of the deadline, tracking the institutional flows, and finding the alpha. Hit subscribe, manage your risk, and I will see you back here tomorrow on Market Pulse.